Welcome to BigONE Weekly News Update. I'm Mia. Global markets delivered a split narrative last week, rising optimism across crypto and equities, alongside a stark reminder of fragility within decentralized finance. Markets rebound, but cautiously. Crypto markets extended their recovery with some hesitation. Bitcoin briefly broke above $78,300 before pulling back, ending the week up about 4.3% near $73,800. Ethereum and Solana posted smaller gains, reflecting steady but cautious momentum. U.S. equities were more decisive. Hopes of a sustained ceasefire following the reopening of the Strait of Hormuz pushed major indices up over 3%, with the S&P 500 hitting record highs and the Nasdaq logging its longest winning streak since 1992. At the same time, Treasury yields declined, the dollar weakened, oil fell sharply for a second week, and gold and silver continued their rally. Kelp DAO exploit, a simple but costly failure. A major DeFi incident disrupted the narrative. Kelp DAO's cross-chain bridge was exploited through a forged message, allowing the attacker to mint roughly $292 million in unbacked RSCTH and borrow about $250 million in ETH across lending platforms. Although the protocol halted activity within 46 minutes, the impact spread quickly. Lending markets froze, liquidity providers withdrew funds, and risk cascaded across the ecosystem. The root cause was not complex code, but flawed design. The bridge relied on a single validator. One forged signature was enough to compromise the system. Composability and systemic risk. This incident highlights a growing issue. DeFi as interconnectedness. Liquid res-taking tokens are widely used as collateral, creating dependencies across platforms. When one protocol fails, others are forced to react simultaneously, freezing markets and absorbing losses. With over $600 million in DeFi exploits already in April, the pace is accelerating. Institutional adoption accelerates. In contrast, institutional momentum continues to build. Goldman Sachs has filed for a Bitcoin income ETF that generates yield by selling covered calls, offering steady cash flow at the expense of upside. Charles Schwab is launching crypto trading for retail clients, while Morgan Stanley's Bitcoin ETF has seen strong early inflows. Fannie Mae is also beginning to accept crypto as collateral for mortgages. Institutional integration is no longer theoretical, it is actively expanding. SDRC. Yield with hidden exposure. Strategy's SDRC preferred stock, yielding 11.5%, has become a major funding tool. Designed to behave like a stable, income-generating asset, it adjusts dividends to keep prices near $100. However, the structure carries notable risks: no maturity, no asset backing, and dividends are not guaranteed. Its credit quality is closely tied to Bitcoin, exposing investors to significant volatility beneath a fixed income-like surface. Bitcoin and the quantum question. The Bitcoin community is also beginning to address long-term risks. The proposed PP361 framework aims to transition toward quantum-resistant addresses over several years. While immediate risk remains low for most users, the debate touches on core principles like ownership and immutability. More importantly, it signals growing awareness of low probability but systemic threats. Conclusion: strength and fragility coexist. Markets are strengthening and institutional adoption is accelerating. Yet beneath the surface, structural weaknesses, especially in DeFi, are becoming clearer. Growth is not just expanding opportunity, it is amplifying risk. When systems fail, it is rarely due to one dramatic flaw, but rather small, overlooked weaknesses exposed only when the pressure builds. Join BigONE today and take advantage of the growing cryptocurrency market.